Before we begin, it's crucial to state that I am not a licensed financial advisor, and this video is for educational and informational purposes only. The financial landscape is complex and personal. The information shared in this presentation is not, and should not be considered, a substitute for professional financial, legal, or tax advice. Please consult with a qualified and licensed professional who can assess your individual situation before making any significant financial decisions. Your financial future is too important to leave to chance. Now let's talk about the biggest, most expensive secret in the entire home buying process. Imagine this for a second. You've done everything right. You've saved for years, you've paid down your credit cards, and you've been obsessively checking your credit score on one of those free apps. You see a beautiful 780 staring back at you. You feel invincible. You find the perfect house, the one with the wraparound porch and the big oak tree in the front yard. You put in an offer, it gets accepted, and you feel that rush of excitement. You march confidently into the mortgage application process, ready to claim the amazing interest rate you deserve. Then you get the call from the loan officer. The rate they're offering is fine, but it's not the rock bottom rate your friend with the same score just got. It's a quarter, maybe even a 0.5% higher. You ask why. The loan officer says, well, based on your qualifying credit score of 738, you almost dropped the phone. 738? That's impossible. My score is 780. I just checked it this morning. And right there, in that single gut-wrenching moment, you've just stumbled upon the hidden trap that costs American homebuyers tens of thousands, sometimes hundreds of thousands of dollars over the life of their loans. The brutal truth is this: the credit score you see on your phone, the one you've been working so hard to improve, is almost certainly not the score your mortgage lender will use. It's not even close. That number is, for all intents and purposes, a fantasy score. It's a vanity metric. And relying on it is like training for the Super Bowl by playing Madden on your Xbox. You might feel like a pro, but you're playing a completely different game with different rules. In this video, we are going to pull back the curtain and expose the real game. We're going to dismantle the entire system and show you step by step the secret world of mortgage credit scoring. By the end of this, you will know more than 99% of homebuyers out there. You will understand precisely which scores lenders pull, how they use them to make a decision, and why that number is so drastically different from what you see online. This knowledge isn't just power, it's money. It's the difference between getting a good rate and getting the absolute best rate possible, saving you a fortune in the long run. So, let's start with the fundamental misunderstanding. People talk about your credit score as if it's a single universal number like your social security number or your date of birth. It's not. There isn't just one FICO score. There are dozens of different FICO scoring models. Think of it like versions of an iPhone. FICO 8 is like the iPhone 12. FICO 9 is the iPhone 13. The newest model, FICO 10T, is like the latest and greatest iPhone 15 Pro. And the free credit monitoring apps? They almost always show you a score from a model called VantageScore, or if they do show a FICO, it's usually the newest version, FICO 8 or FICO 9. Why? Because these scores are great for general consumer credit. They're fantastic for getting an idea of your overall credit health for things like credit card applications or personal loans. They're modern, they're fast, and they react quickly to your recent financial behavior. But mortgage lenders, they don't use the new shiny iPhone. When it comes to underwriting a 30-year $500,000 loan, they are incredibly conservative. They use the old, reliable, battle-tested Nokia brick phone. They use much older, more archaic versions of the FICO score that have been the industry standard for decades. They don't care about the new scoring models. They use a specific classic trio of FICO scores that are designed exclusively to predict the likelihood of you defaulting on a mortgage. These are the only 3 numbers that matter. Here they are. Write these down. This is the secret handshake. From Experian, they pull your FICO score 2. From Equifax, they pull your FICO score 5. And from TransUnion, they pull your FICO score 4. You've probably never even heard of these versions. You certainly won't find them on your free credit app. These are the old-school, heavyweight champions of mortgage lending. They are less forgiving, slower to change, and they weigh certain factors much more heavily than the newer scores you're used to seeing. A late payment from 5 years ago that barely registers on your FICO 8 score might still be a huge red flag on your FICO 2. These older models are obsessed with long-term stability and are deeply skeptical of short-term fixes. So, the lender pulls these 3 specific old-school scores. Now what? Do they average them? No, that would be too simple. Instead, they do something that trips up almost every single homebuyer. They take your 3 scores, the FICO 2, the FICO 5, and the FICO 4, and they throw out the highest one. Then they throw out the lowest one. The single score they use to determine your interest rate, your loan terms, and even whether you get approved at all is the one left sitting in the middle. This is called your middle score, or your representative score. Let's see how this plays out in the real world, because this is where the money is won or lost. Let's go back to our homebuyer from the beginning. Let's call her Jessica. Jessica was so proud of her 780, but that was her Vantage score 3.0. When her mortgage lender pulled her credit, here's what they actually saw. Her FICO score 2 from Experian was a 738. Her FICO score 5 from Equifax was a 725. And her FICO score 4 from TransUnion was a 760. So what does the lender do? They ignore her best score, the 760. They ignore her worst score, the 725. The number that determines her financial fate for the next 30 years is the middle score, 738. Suddenly it all makes sense. She's not a 780 borrower. She's not even a 760 borrower. In the eyes of the mortgage world, she is a 738. And in the world of mortgages, the difference between a 760 and a 738 isn't just 22 points. It's a different pricing tier. It's a higher interest rate. It's thousands of dollars in extra interest payments every single year. This middle score rule is why you can have one absolutely stellar score and one terrible score, and still end up with a mediocre qualifying score. Let's take another example, Mike. Mike has been working hard on his credit. His FICO 2 Experian is a 790. Amazing. His FICO 5 Equifax is a 775. Still fantastic. But his FICO 4 TransUnion is a 718. Ouch. Maybe there's an old collection account on that report he didn't clean up, or a forgotten late payment. What's Mike's qualifying score? It's not the average. It's not the 790. The lender throws out the 790, throws out the 718, and bases their entire multi-$100,000 decision on his middle score of 775. This is the game. It's not about having the highest possible score on one bureau. It's about having 3 solid, consistent scores across all 3 bureaus, specifically on these older, tougher scoring models. Your credit score isn't your strongest link. It's your middle link. And that changes everything about how you should be preparing to apply for a mortgage. The question you should be asking now is, okay, if these scores are different, how are they different? What do they care about that my FICO 8 doesn't? That is the million-dollar question. These classic models are far more sensitive to things like bankruptcies, foreclosures, and judgments. They look at your debt-to-limit ratios on revolving credit in a much stricter way. They aren't as impressed by some of the newer credit-building tactics, like having a high number of new accounts or using some of the credit-boosting services. They prioritize a long, stable, and flawless payment history above all else. They are looking for a marathon runner, not a sprinter. So now you know the secret. You know that you're not playing one game, you're playing 3. You know the names of your real opponents, FICO 2, 5, and 4. And you know the rule that determines the winner, the middle score. This is the foundational knowledge that separates the informed homebuyer who gets an incredible deal from the frustrated one, who can't figure out why their great credit score isn't getting them the rate they were promised. You are now officially on the inside. So let's pull back the curtain on the very first, and arguably most important, secret of the mortgage credit world. It's a concept that instantly explains the frustration so many people feel. It's called the tri-merge, and it's the reason the score you see on your banking app or your favorite free credit website is, at best, a well-intentioned guess. Imagine a homebuyer. Let's call her Sarah. Sarah has been diligent. She's paid her bills on time, kept her credit card balances low, and for the last year, she's been obsessively checking her credit score on a popular app. The day she decides to get pre-approved for a mortgage, her app flashes a beautiful number, 780. She's ecstatic. A 780 FICO score is in the excellent category. She walks into the lender's office, confident she'll be offered the best interest rates imaginable. She pictures the new house, the moving truck, everything. The loan officer runs her information, pulls her credit, and comes back with a number. But it's not 780. The loan officer says her qualifying score is 742. Sarah's confused, then frustrated. A 742 is still a good score, but it's not an excellent 780. It's the difference between a good interest rate and the best interest rate. A difference that could cost her tens of thousands of dollars over the life of the loan. She pulls out her phone. "But look," she says. "It says right here 780. The loan officer nods sympathetically. He's had this exact conversation 1,000 times. What Sarah doesn't know, and what you're about to learn, is that her lender isn't looking at just one score. In the United States, there are 3 major credit bureaus: Experian, Equifax, and TransUnion. Think of them as 3 separate, competing private investigators, each keeping a detailed file on your financial life. When you apply for a simple credit card, the lender might only bother to check with one of them. It's fast and cheap. But a mortgage? A mortgage is one of the biggest financial commitments a bank can make. They aren't going to cut any corners. So when a mortgage lender pulls your credit, they perform what's called a tri-merge credit pull. They don't ask for just your Experian report or just your TransUnion report. They pay to pull all 3 reports simultaneously and merge them into one master document. And here's the crucial part. Each of those 3 reports will generate its own unique credit score. You don't have one credit score. You have at least 3. On that particular day, Sarah's scores might have been an Experian score of 738, an Equifax score of 742, and a TransUnion score of 780. The app she was using just happened to show her the TransUnion score, the highest one. It gave her a skewed, overly optimistic view of her standing. So now the lender is sitting there with 3 different numbers: 738, 742, and 780. What do? Do they average them? No, that would be too simple. Do they take the highest one to give you the benefit of the doubt? Absolutely not. Do they take the lowest one to be as conservative as possible? Not quite. The rule in the mortgage industry is as strange as it is universal. They use your middle score. They literally take your 3 scores, throw out the highest one, throw out the lowest one, and use the number that's left in the middle as your official qualifying credit score. In Sarah's case, they would discard her amazing 780 from TransUnion, discard her lower 738 from Experian, and base the entire loan, the interest rate, the terms, the private mortgage insurance, on her middle score of 742 from Equifax. And just like that, the mystery is solved. Sarah's frustration disappears and is replaced by understanding. This single piece of information, the middle score rule, is the key. But that begs the next question: why? Why are the scores different in the first place? Seems like they should all be the same. The reason they differ comes down to 3 simple things. First, not all of your creditors report to all 3 bureaus. Your auto loan might report your perfect payment history to all 3, but your local credit union credit card might only report to Equifax and TransUnion. That means Experian has no idea that account even exists. It's not on their report, so it's not factored into their score calculation. If you have a great history with that card, your Experian score might be unfairly lower. If you have a terrible history, it might be artificially higher. Second is the timing of updates. The bureaus don't all update in real time or on the same schedule. Let's say you pay off a big credit card balance on a Monday. TransUnion might get that new, updated information on Tuesday, and your score could jump 20 points. But Equifax might not receive that data from the credit card company until Friday. So for 3 days, your TransUnion score and your Equifax score are telling 2 different stories about the exact same event. And third, and this is a big one, are errors. One bureau might have a mistake on your report that the others don't. It could be an account that isn't yours, a late payment that was actually on time, or a collection account that was paid off years ago but is still showing as active. A single significant error on just one of your 3 reports can torpedo that one score, potentially dragging it down from being your highest or middle score to being your lowest, completely changing the outcome of your mortgage application. Now this is where the story gets even more complex and, for many couples, much more painful. What happens when 2 people are applying for the mortgage together? Let's bring in Sarah's husband, Mike. Mike is also financially responsible. He has a good job and pays his bills. So now the lender pulls a tri-merge report for Sarah and a tri-merge report for Mike. The desk is now covered with 6 credit scores: Sarah's 738, 742, and 780. And let's say Mike's scores are 685, 690, and 710. The lender follows the same process but twice. First, they find Sarah's middle score. They throw out the high and low, and they're left with 742. Then they find Mike's middle score. They throw out his high of 710 and his low of 685, and they're left with 690. So now they have 2 qualifying scores: Sarah's 742 and Mike's 690. Which one does the bank use to approve the loan and set the interest rate? This is the rule that shocks almost every couple I've ever spoken to. The lender uses the lower of the two middle scores. It doesn't matter that Sarah's score is a pristine 742. It doesn't matter if one partner has a perfect 850 score. The entire loan application, every financial calculation, every dollar they will pay in interest for the next 30 years, will be based on Mike's 690, the lower score. This is why a couple can have one partner with perfect credit and still be denied a loan or get a surprisingly high interest rate. The loan is only as strong as its weakest link. Suddenly you can see the chessboard. This isn't about one number on your phone. It's about a complex interplay of 3 different data streams for each applicant. Understanding this system is the first giant leap toward controlling it. You are no longer in the dark, wondering why the lender's number doesn't match your app. You know they are looking at your middle score from a tri-merge report. And if you're applying with a partner, you know it's the lower of your 2 middle scores that truly counts. This knowledge transforms you from a passive applicant into an active strategist. You realize that you don't just need to improve your credit. You need to know what all 3 of your reports say, identify the weakest of the 3, and focus your efforts there. You need to know your partner's 3 scores just as well as your own, because in the world of mortgages, you're a team, and you're judged by the lower score on the field. But here's the next turn in the maze. Now you know which score they use, the middle one. But what if I told you the type of score they use is completely different from what you're used to seeing? That FICO itself has dozens of different scoring models like different versions of software, and that mortgage lenders are required by regulation to use specific, older, and often much harsher versions than the ones you see on free websites. The number you see might be a FICO 8 or a FICO 9, but the lender is pulling a FICO 2, 4, and 5. And the difference between those versions can be staggering. That is the next secret we need to expose. So why are lenders using these ancient, mysterious score versions? The answer is both simple and incredibly frustrating because they have to. The entire mortgage industry in the United States is built on a foundation of guidelines set by 2 giants, Fannie Mae and Freddie Mac. These are the government-sponsored enterprises that buy up the majority of home loans from lenders, which frees up the lenders' cash to go and make more loans. It's the engine of the housing market. And for decades, Fannie and Freddie have mandated that lenders use these specific, older FICO models to assess risk. They are time-tested, predictable, and the entire system is built around their outputs. Switching to a new scoring model across the entire $50 trillion housing industry is like trying to change the engine on a 747 while it's in mid-flight. It's a monumental task, and it moves at a glacial pace. So while you're using a modern app on your smartphone that shows you a FICO 8 or a VantageScore 3.0, the lender is forced to use the financial equivalent of a dial-up modem. They aren't trying to trick you. They're just playing by a very old, very rigid set of rules. Now this is where it gets even more complicated. The lender doesn't just pull one of these older scores. They pull 3. This is what's known in the industry as a tri-merge credit report. They pull a report from each of the 3 major credit bureaus, Experian, Equifax, and TransUnion. And each bureau's report will come with a corresponding mortgage credit score. Specifically, the report from Experian uses the FICO 2 model. The report from Equifax uses the FICO 5 model. And the report from TransUnion uses the FICO 4 model. So now instead of 1 credit score you have 3. Let's say your Experian FICO 2 is a 721, your Equifax FICO 5 is a 698, and your TransUnion FICO 4 is a 715. Which score does the lender use? Do they take the highest one? The lowest? Do they average them out? The answer is none of the above. They use the middle score. In this example, the lowest is 698, the highest is 721, so the middle score is 715. That is your qualifying score. That single number is what determines your interest rate, your fees, and in some cases whether you get the loan at all. This is one of the most misunderstood aspects of mortgage lending. People work tirelessly to get their scores up, see a great number on a free website, and then walk into a lender's office only to be told their qualifying score is 30, 40, or even 50 points lower than they expected. It can be a soul-crushing experience. Let's imagine a couple, we'll call them Mike and Jessica. For a year, they've been preparing to buy their first home. They use a popular credit monitoring app. They've paid down their credit cards, made every payment on time, and avoided any new debt. Their app proudly displays Mike's score as a 750 and Jessica's as a 762. They are ecstatic. They've reached the top tier. They walk into the bank, ready to get the absolute best interest rate available. The loan officer pulls their tri-merge report. He turns the screen around to show them. Mike's scores are FICO 2, 725, FICO 5, 708, and FICO 4, 719. His middle score is 719. Jessica's scores are FICO 2, 733, FICO 5, 720, and FICO 4, 728. Her middle score is 728. Now, if they are applying for the loan together, the lender doesn't even use the higher middle score. They use the lower of the two qualifying scores. So, despite Jessica's 728, the score that their entire loan application hinges on is Mike's 719. In the space of 5 minutes, they went from feeling like 760 club VIPs to being judged on a 719. That's a 41-point drop from what they thought their score was. Why? What causes this massive discrepancy? It's because these older mortgage score models weigh information very differently than the newer FICO 8 you see online. Think of FICO 8 as a friendly, optimistic score. It wants to give you the benefit of the doubt. The mortgage scores 2, 4, and 5 are like a skeptical, old-school bank manager. They are far more conservative and risk-averse. Let's break down the key differences. First, small collection accounts. Let's say you had an old medical bill for $80 that you forgot about and it went to collections. The newer FICO 8 and FICO 9 models will completely ignore paid collections. And they also ignore any collection account with an original balance under $100. It's a gesture of goodwill, understanding that small, pesky things happen. The old mortgage scores offer no such forgiveness. A collection is a collection. That $80 unpaid bill, even from 5 years ago, is a red flag that will actively suppress your FICO 2, 4, and 5. Second, authorized user accounts. This is a common strategy where parents add their kids to a long-standing credit card account to help them build credit. The newer FICO 8 is pretty good at recognizing this and giving you credit for that long positive history. The older mortgage scores are much more skeptical. Their algorithm is more likely to discount, or in some cases, completely ignore the benefits of an authorized user account because it's not truly your credit history. So that 20-year-old credit card from your parents that's boosting your FICO 8 score might be doing almost nothing for your all-important mortgage score. Third, the impact of recent activity. Mortgage scores are intensely focused on your behavior in the last 12 to 24 months. They are hypersensitive to any recent late payments. A single 30-day late payment within the last year can cause a catastrophic drop in your mortgage scores, far more severe than what you might see on your FICO 8. They also heavily penalize high credit utilization. If you've maxed out a credit card recently, even if you plan to pay it off next month, the mortgage scores will see that as a sign of financial distress and punish you for it. FICO 8 penalizes this too, but the mortgage scores do so with more severity. They are looking for stability above all else. They want to see low balances, maintained over a long period, with a flawless payment history. Let's go back to Mike. Why was his score so much lower? It turns out, 2 years ago, he was 30 days late on a car payment. It had mostly recovered on his FICO 8 score, but the FICO 2 mortgage score was still holding it against him. He also had a small forgotten collection for a $95 cable bill from a college apartment he left 4 years ago. FICO 8 ignored it. The mortgage scores did not. Those two small items were the source of the 41-point gap. And what does that 41-point gap actually mean in the real world? It's not just a number on a piece of paper. It's money. Real money coming out of your pocket every single month for the next 30 years. A qualifying score of 760 gets you the absolute best, top-tier interest rate a lender can offer. A score of 719 is still good, you'll definitely get a loan, but you're not getting the best rate. You've slipped down a pricing tier. Let's put numbers to it. On a $400,000 home loan, the difference between the best rate at a 760 score and the rate you might get at a 719 score could easily be 0.25% or 0.25%. That might sound tiny, but that 0.25% difference translates to roughly $60 more on your monthly payment. That's $720 extra per year. Over the 30-year life of the loan, Mike and Jessica would pay over $21,000 more in interest than they would have if their score had been what they thought it was. $21,000. That's a new car, a kitchen renovation, college fund for a child, all lost simply because they were tracking the wrong number. This is the hidden trap of the mortgage credit score system. It operates on a different set of rules, uses different models, and has a different definition of what makes a borrower low risk. And most people have no idea until it's too late. until they're sitting in the loan officer's chair, looking at a number they don't recognize, and watching their dream interest rate slip away. So the critical question becomes, how do you stop this from happening to you? How can you arm yourself with the right information before you ever talk to a lender? Is there a way to see your own FICO 2, 4, and 5 scores, the real scores that matter, without having a lender pull your credit? For a long time, the answer was no. But now there is a way. There is a specific service you can use to see the exact same report the lender sees. It's the single most powerful tool you can have in your home buying arsenal, and almost no one knows it exists. That is the secret we are unlocking next. This service is called myfico.com. And no, this is not a sponsored video. This is simply the unvarnished truth about where to get the data that matters. MyFICO is the consumer-facing division of the Fair Isaac Corporation, the very company that invented the FICO score. Going to them is like getting water directly from the source. While other services give you an estimate, a simulation, or a different brand of score altogether, this is the only place a consumer can go to see the vast majority of the specific FICO score versions that lenders actually use. When you sign up for their top-tier plan, you don't just get a single number. You get what's called a tri-merge credit report with a full FICO score panel. That sounds complicated, but let's break it down, because this is the key that unlocks everything. A tri-merge report is exactly what it sounds like. It pulls your credit data from all 3 major bureaus, Experian, Equifax, and TransUnion, and merges them into a single comprehensive document. This is what your lender sees. They don't just pull from one bureau. They pull from all 3, because your information can be slightly different at each one. A creditor might only report to 1 or 2 bureaus, not all 3. So, to get the full picture, the lender needs the complete file. But here's the most important part. The report doesn't just show you one score. It shows you a whole dashboard of different FICO scores. You'll see scores for auto loans, credit card applications, and most importantly, the specific old-school FICO models used for mortgages. These are the ones that matter. For decades, the mortgage industry has relied on a specific set of classic FICO scores. These are FICO Score 5 from Equifax, FICO Score 2 from Experian, and FICO Score 4 from TransUnion. Notice how they're not the newest versions like FICO 8, 9, or 10, which you might see elsewhere. Why? Because the mortgage industry is slow to change. These older models are the ones that have been battle-tested for decades. Fannie Mae and Freddie Mac, the giants who buy most of the mortgages in America, mandate the use of these specific classic scores. So, those are the scores your lender is forced to use. When your lender pulls your tri-merge report, they will see 3 scores, one from each bureau using these specific models. Let's say your FICO Score 2 from Experian is a 735. Your FICO Score 5 from Equifax is a 719. And your FICO Score 4 from TransUnion is a 728. Now, which score do they use? Do they average them? Do they take the highest one? The lowest one? The answer is none of the above. This is one of the biggest secrets in the industry. Lenders use your middle score. In this example, the scores are 735, 719, and 728. They throw out the highest score, 735. They throw out the lowest score, 719. They base their entire lending decision, your interest rate, your fees, whether you even get the loan, on the middle score of 728. This is your qualifying score. If you are applying with a co-borrower like a spouse, the lender pulls a tri-merge report for both of you. Then they look at both of your middle scores, and they use the lower of the 2 middle scores to make their decision. It's a brutally conservative process, but it's the reality of the system. So let's put this into a real-world story. Meet Sarah. Sarah is diligent. She's been saving for a down payment for 3 years. She uses a free credit monitoring app that tells her she has a fantastic 780 credit score. She walks into a lender's office, confident and proud. She's pre-approved, but when she gets the paperwork, the interest rate is a little higher than the best rates she saw advertised online. She's confused. "But I have a 780, she says. The loan officer pulls up her file. He explains that her 780 score was a VantageScore 3.0, an educational score. Her actual FICO mortgage scores were 755, 741, and 738. The lender had to use her middle score, which was 741. Now, a 741 is a great score, but in the world of mortgages, it falls into a different pricing bracket than a 780. The difference might seem small, but on a $300,000 loan, That slight bump in interest rate could cost Sarah over $20,000 in extra interest payments over the life of the loan. $20,000. All because she was looking at the wrong number. She was flying blind and didn't even know it. This is why getting your hands on your real mortgage scores is not just a nice to have. It is an absolute necessity. It's the difference between guessing and knowing. It's the difference between being a passenger in your home buying journey and being the pilot. Now you might be wondering, why are the scores so different? Why was Sarah's FICO mortgage score so much lower than her Vantage score? It's because these older FICO models are more strict. They were designed in a different era of data analysis. They can be more sensitive to things like credit utilization, meaning how much of your available credit you're using. A newer score might not penalize you as much if you have a credit card balance of 50% of your limit. But an older FICO model like FICO Score 2 might see that as a significant risk factor and drop your score more severely. These older models also have a longer memory for negative events and a different way of weighing the length of your credit history. They are, by design, less volatile and more skeptical than the scores you see for free. They were built to assess the risk of you paying back a loan for 30 years, not to give you a weekly pat on the back. So when you finally pull that real tri-merge report from a service like MyFICO, it can be a shocking moment. You will see the numbers that have been hidden from you. You might see a middle score that's 20, 40, or even 60 points lower than you thought. And your first reaction might be panic or frustration. But I want you to reframe that feeling. That feeling is not panic. It's power. Because for the first time, you are looking at the same map the lender is looking at. You are no longer navigating in the dark. You now know the exact number you need to improve. If your middle score is the 719 from Equifax, you now know that focusing your efforts on the data within your Equifax report is the most direct path to a better loan. This report is more than just a set of numbers. It's a diagnostic tool. It's a personalized instruction manual for getting the best possible mortgage. Buried inside that report are the exact reasons why your scores are what they are. They are called risk factors or adverse action codes. These are plain English sentences that tell you precisely what is holding your score back. Things like, proportion of loan balances to loan amounts is too high, or time since most recent account opening is too short. Most people get this report, look at the 3-digit number, and close the file. But the real gold is in those reason codes. They are your to-do list. They are the cheat codes for the entire lending game. Understanding what they mean and how to act on them is the single most important financial skill a prospective homebuyer can learn. And that is exactly what we are going to do. Now that you know where to get the real report, the next step is to learn how to read it like a seasoned loan officer. We are going to become credit report detectives, dissecting each section, decoding those risk factors, and creating a strategic, customized plan to boost that all-important middle score. We will turn that raw data into a concrete action plan that can save you tens of thousands of dollars. So, what does this action plan actually look like? It's not some vague advice like pay your bills on time. That's table stakes. This is a surgical 5-part framework. Think of it as the 5 fundamental laws of physics for your mortgage credit score. If you master these, you control your own financial gravity. We're going to break down the exact FICO scoring model percentages, so you know precisely where to focus your energy for the biggest impact. The first and most powerful law, the one that accounts for a massive 35% of your entire score, is payment history. This isn't just a category. It's the bedrock of your financial reputation. Every single time you make a payment on time, you are sending a signal to the credit bureaus, and by extension to your future mortgage lender. The signal says, I am reliable. I honor my agreements. I am a safe bet. Conversely, every time a payment is late, even by a day past its reporting date, it sends a screaming red flare that says, risk. I might not be able to handle this commitment. Lenders see a 30-day late payment as a stumble. A 60-day late is a serious fall. And a 90-day late? That's a financial car crash in their eyes, and it can stay on your report, haunting your score for 7 long years. For a mortgage underwriter, a recent late payment, especially on another housing-related debt like rent or a previous mortgage, is one of the biggest red flags imaginable. It directly questions your ability to handle the single most important payment you'll have. So the action item here is non-negotiable and absolute. Automate everything. Every credit card, every car loan, every student loan payment needs to be on autopay for at least the minimum amount. No exceptions, no excuses. You can always pay more manually, but the minimum must be guaranteed to be on time every time. This single habit is the most powerful score-boosting and score-protecting action you can possibly take. It builds a flawless track record of trust, and in the world of lending, trust is currency. Now let's move to the second law, which is nearly as powerful. It accounts for 30% of your score, and it's the one most people misunderstand: credit utilization. This sounds complicated, but it's just a simple ratio. It's the amount of revolving credit you're currently using divided by the total amount of revolving credit you have available. Imagine your total credit limit across all your credit cards is a gas tank. If you have $10,000 in total limits and a $5,000 balance, your tank is half full. Your utilization is 50%. Here's the critical insight. Lenders see high utilization as a sign of financial distress. If your gas tank is always running close to empty, it looks like you're living on the edge, relying on credit to get by. It suggests you don't have enough cash flow, which is a terrifying thought for someone about to lend you hundreds of thousands of dollars. The common advice you hear is to keep your utilization below 30%. And that's not bad advice for general credit health. But for getting a mortgage, it's amateur hour. For a mortgage application, you need to be in the major leagues. We're not aiming for good, we're aiming for elite. The secret number that mortgage underwriters love to see is under 10%. Yes, single digits. Someone with a $10,000 limit and a balance of $900 looks infinitely more stable and responsible than someone with a balance of $2,900, even though both are technically under 30%. The action plan here has two parts. First, calculate your overall utilization right now. Add up all your credit card balances and divide by your total credit limits. Then, create a plan to aggressively pay that down to below 10%. The second part is a pro-level trick. Pay your balance before the statement closing date. Most people wait for the bill, then pay it. But the credit card company usually reports the balance to the bureaus on that statement date. So even if you pay in full every month, your report might still show a high balance for a few weeks. By paying it down to near zero a few days before the statement closes, you ensure that the number reported to the bureaus is as low as humanly possible. This is how you manufacture a perfect utilization ratio. The third law, accounting for 15% of your score, is the length of your credit history. Time is a powerful force in finance. Lenders want to see a long, established track record. It's like hiring someone for a job. A resume with 15 years of steady experience is more comforting than one with only 15 months. This category looks at two main things: the age of your oldest account and the average age of all your accounts combined. This is where people make a catastrophic mistake. They'll pay off an old credit card from college and in a fit of tidiness they'll close the account. Do not do this. Closing that old account is like taking your longest-serving, most loyal employee and firing them. You instantly erase that entire history from your length of credit calculation. Worse, it lowers your average age of accounts. If you have a 10-year-old card and a 2-year-old card, your average age is 6 years. If you close the old one, your average age plummets to just 2 years overnight. Your score will take a direct hit. The action plan here is simple but requires discipline. Keep your old, no annual fee credit cards open forever. Use them once every 6 months for a small purchase, a pack of gum, a coffee, and then pay it off immediately. This keeps the account active and reporting, anchoring your credit history in the past, and continuously increasing your average age of accounts. It's a passive, long-term strategy that pays huge dividends when it's time to apply for a mortgage. Next, we have our fourth law, which makes up 10% of your score: credit mix. Lenders are looking for a well-rounded financial portfolio. They want to see that you can responsibly manage different types of debt. There are two main flavors: revolving credit, like credit cards, where the balance can go up and down, and installment loans like an auto loan or a student loan, where you pay a fixed amount for a set period until it's paid off. Having a healthy mix, say a couple of credit cards and one installment loan, shows a breadth of experience. It proves you can handle both the discipline of a fixed payment and the flexibility of a revolving line of credit. However, and this is a huge caveat, this is not something you should try to game right before applying for a mortgage. The absolute worst thing you could do is think, "Oh, I don't have an installment loan. I should go get a small personal loan to improve my mix." The damage from the hard inquiry and the new account, which we'll get to next, will far outweigh any tiny benefit from an improved credit mix. The action plan for credit mix is mostly passive. Let it build naturally over time. If you have student loans or a car loan, great. If you don't, that's fine too. Focus your energy on the big two: payment history and utilization. A perfect record there is far more important than a perfect mix of accounts. Finally, we arrive at the fifth law, also accounting for the last 10% of your score, new credit. This category is all about how recently and how often you've been applying for new credit. Every time you formally apply for a loan or a credit card, it results in a hard inquiry on your report. From a lender's perspective, a sudden flurry of hard inquiries is a massive warning sign. It looks like you're desperate for cash, maybe trying to open up a bunch of new cards to stay afloat or to finance a down payment, which is a huge no-no. It screams increased risk. A few inquiries spread out over a couple of years is normal, but 5 or 6 in the last 6 months, that's going to make a mortgage underwriter extremely nervous. Each hard inquiry can ding your score by a few points, but the cumulative effect of many is what does the real damage, both to the score itself and to the perception of your financial stability. The action plan here is the most critical in the months leading up to your mortgage application. You go on a credit lockdown. For at least 6 months and ideally a full year before you apply for a home loan, you do not apply for anything else. No new credit cards for the bonus miles. No new store cards for the 10% discount. And absolutely positively no new car loan. Buying a new car right before buying a house is one of the most common and devastating mistakes a homebuyer can make. It adds a hard inquiry, it lowers your average age of accounts, and it saddles you with a new monthly debt payment that directly reduces the amount of mortgage you can qualify for. So there you have it. The 5 laws. Payment history at 35%, utilization at 30%, length of history at 15%, and credit mix and new credit at 10% each. This is the blueprint. This is the scoring model laid bare. You now know exactly what matters and by how much. But knowing the rules of the game is only half the battle. The other half is strategy. It's about timing. It's about knowing which levers to pull and in what order during that crucial 3, 6, or 12-month run-up to your application. And that is precisely where we're going next. We're going to build your timeline, your step-by-step, 90-day game plan to optimize every single one of these 5 laws. Alright, let's get into the trenches. This is where the theory stops and the action begins. Your 90-day mission, should you choose to accept it, is to transform your credit profile from applicant to ideal borrower. Every day for the next 3 months counts. Every decision matters. This isn't just about boosting a number. It's about saving you tens of thousands of dollars over the life of your loan. We're going to break this down into 3 distinct 30-day phases. Phase 1, the great cleanup. Phase 2, the strategic build. And Phase 3, the lockdown. Let's start with Phase 1, the great cleanup. This covers the first 30 days, from day 90 down to day 60 before your application. Your objective here is to find and fix the problems. Your very first move on day 90 is to pull your full credit reports. Not the free score you get from your credit card app. I mean the full detailed intelligence dossiers from all 3 bureaus, Equifax, Experian, and TransUnion. You are legally entitled to these for free once a year from a single specific government-mandated website, annualcreditreport.com. This is non-negotiable. Flying blind is the fastest way to get denied. You need to see exactly what the lender is going to see. Once you have those reports, you begin your second move, the forensic audit. You are now a detective, and your credit history is the crime scene. You are looking for errors because they are far more common than you think. A study by the Federal Trade Commission found that 1 in 5 people had an error on at least one of their reports. That could be you. Print them out. Get 3 different colored highlighters. Go through every single line item. Are there late payments listed that you know you made on time? Is there an old medical bill in collections that was supposed to be paid by your insurance? Is there a credit card listed that you've never even heard of? This is identity theft's calling card. Even a simple clerical error, like a misspelled name or a wrong address, can link someone else's bad debt to your file. I once worked with a client who was being held back by a 90-day late payment on a car loan. The problem? He'd never owned that kind of car. It belonged to his father, who had a nearly identical name. That one error was costing him nearly 40 points. This brings us to your third move in the cleanup phase, the dispute campaign. When you find an error, you don't just get mad, you get strategic. You must dispute the error directly with the credit bureau that is reporting it. Each bureau has a straightforward online dispute process. You'll state your case, provide your evidence, like a bank statement showing a timely payment or a letter from a creditor, and they are legally required by the Fair Credit Reporting Act to investigate, usually within 30 days. Don't just dispute it with one bureau. If the error appears on all 3 reports, you launch a 3-front war. You dispute it with Equifax, Experian, and TransUnion simultaneously. This is your right, and it is the single fastest way to remove inaccurate negative information that is unfairly dragging you down. Now for the final and most critical part of Phase 1, the debt triage. This directly targets the second law of credit scoring, amounts owed, which accounts for 30% of your score. I want you to make a list of all your revolving debts, your credit cards. For each card, write down the total credit limit and the current balance. Now, calculate your credit utilization ratio for each card. That's the balance divided by the limit. A card with a $500 balance on a $1,000 limit is at 50% utilization. A card with a $5,000 balance on a $20,000 limit is at 25% utilization. Here is the secret key. The mortgage FICO models are brutally sensitive to high utilization on individual cards, not just your overall average. Your mission is to attack the cards with the highest utilization ratio first. This is counterintuitive. Most financial gurus tell you to pay off the card with the highest interest rate. That's great for saving money on interest, but we are not trying to save a few bucks in interest right now. We are trying to rapidly maximize your credit score. That maxed out store card with a $500 limit is doing exponentially more damage to your score than the bank card with a $5,000 balance and a $20,000 limit. Pay that store card down below 30%, and ideally below 10% as fast as you can. Scrape together every extra dollar for these 30 days, and throw it at your highest utilization cards. This is the financial equivalent of putting out the biggest fire first. Okay, 30 days have passed. You've disputed errors, you've hammered down your high utilization debt. Now we enter Phase 2, the strategic build. This is from day 60 to day 30. Your objective here is to actively demonstrate positive credit behavior. The cleanup was defense. This is offense. First, for the next 30 days, I want you to use your credit cards for 1 or 2 small planned purchases. A tank of gas, a bag of groceries. Then, and this is crucial, pay it off in full the very next day. Do not wait for the statement to arrive. Why? This shows recent, positive, and responsible activity on your accounts. It tells the algorithm that you are an active and reliable user of credit, which reinforces the most important law, payment history. It also helps with the length of credit history and credit mix components by keeping your accounts active and in good standing. Next is a power move, but it comes with a massive warning. It's called becoming an authorized user. If you have a parent, spouse, or trusted family member with a long-established credit card that has a perfect payment history and a very low balance, they can potentially add you to their account as an authorized user. You don't even need to have the physical card. The entire positive history of that account, its age, its high limit, its perfect payments, can be grafted onto your credit file, sometimes boosting your score in as little as 30 to 60 days. It's a way of inheriting a good credit history. But hear me loud and clear. This is a double-edged sword. If that person ever misses a payment or runs up a huge balance, their mistake becomes your mistake. It will appear on your credit report and can devastate your score. You should only ever do this with someone you would trust with your life savings. Now we enter the final 30 days. Phase 3, the lockdown. From day 30 to day 0, the objective here is simple. Do no harm. You have cleaned, you have built, now you must protect. The number 1 rule of the lockdown is a complete and total credit hibernation. You will not, under any circumstances, apply for any new credit. I don't care if you're offered 20% off a new refrigerator. I don't care if you get a pre-approved offer for the world's greatest travel card in the mail. Do not apply for a new car loan. Every time you apply for credit, it generates a hard inquiry on your report. A single inquiry might only drop your score by a few points, but a flurry of them right before you apply for a mortgage is a giant, flashing red light to underwriters. It screams desperation and increased risk, so you will apply for nothing. The second rule of the lockdown is the balance freeze. In Phase 1, we aggressively pay down debt. In Phase 3, we keep it at rock bottom. Your goal is to have all your credit card statements report a balance that is as close to 0 as possible. Here's a pro tip. Your credit card company usually reports your balance to the credit bureaus on your statement closing date, not your payment due date. Find out your statement closing date for each card. Make sure you pay off the balance in full a few days before that date. This way, a beautiful low utilization balance gets reported, giving your score one final push right before the lender pulls your file. Finally, the third rule: become a financial ghost. Do not make any large, unusual financial moves. Don't deposit a large sum of cash into your bank account without a paper trail. This is a red flag for money laundering and will have to be explained. Don't withdraw a huge sum of cash. Don't co-sign a loan for your cousin. Don't change jobs unless it's a clear and obvious promotion in the same field. And for the love of all that is holy, do not buy furniture, appliances, or a car for the new house you don't even own yet. Lenders often do a final credit check right before closing. Any new debt or weird activity can kill the entire deal at the 11th hour. Your job in these final 30 days is to be stable, predictable, and boring. So there it is. Your 90-day game plan. Phase 1, the Great Cleanup. Find and fix errors and destroy high utilization debt. Phase 2, the Strategic Build. Demonstrate responsible use and consider advanced tactics like an authorized user account. Phase 3, the Lockdown. Freeze all new credit applications and major financial moves. This is the roadmap. This is how you walk into a lender's office with the confidence of someone who has left nothing to chance. But this plan assumes you're dealing with standard credit issues. What if you have one of the big ones? A true score killer sitting on your report. I'm talking about a bankruptcy, a foreclosure, a stubborn collection account that just won't go away. These are the landmines of the credit world, and they require their own unique set of strategies to navigate. And that is exactly what we're going to defuse next. Let's start with the big one, bankruptcy. Just the word itself can feel like a life sentence for your financial goals. But here's the truth underwriters know that you need to know. Bankruptcy is not a character flaw. It's a legal tool. For many, it's a reset button. A painful but necessary step to get out from under an impossible mountain of debt, often caused by a medical crisis or a job loss. Lenders understand this. They aren't looking to punish you forever. They're looking for proof that you've learned from the experience and are now a responsible borrower. That proof is measured in one thing: time. This is called the seasoning period. It's the mandatory waiting time from the date your bankruptcy is discharged or dismissed until you can be approved for a new mortgage. And this is where the details matter immensely. There are two main types of personal bankruptcy, and they have different timelines. Chapter 7 or liquidation bankruptcy is the most common. It wipes the slate clean on most of your unsecured debts. After a Chapter 7 discharge, you're generally looking at a waiting period of 2 years for an FHA or VA loan, and 4 years for a conventional loan backed by Fannie Mae or Freddie Mac. Now there's a critical exception. If you can prove that the bankruptcy was the direct result of extenuating circumstances beyond your control, think a major illness, a natural disaster, or the death of a primary wage earner, and you can document it thoroughly, that waiting period can sometimes be reduced to as little as 1 year for FHA and VA, or 2 years for conventional. But the burden of proof is entirely on you. Then there's Chapter 13, the reorganization bankruptcy. This is where you enter a repayment plan over 3 to 5 years. Lenders often view a Chapter 13 more favorably because you're actively repaying a portion of your debt. The rules here are a bit different. For FHA and VA loans, you can potentially qualify for a mortgage after you've made just 12 months of on-time payments into your Chapter 13 plan. You don't even have to wait for it to be discharged. However, you will need permission from the bankruptcy court trustee, and the lender will scrutinize your budget like a hawk to ensure you can handle both the repayment plan and the new mortgage. For a conventional loan, the clock starts after the discharge, typically requiring a 2-year wait. The key takeaway for any bankruptcy is this: the clock doesn't start until it's over. And during that waiting period, you cannot afford a single financial misstep. You are rebuilding your credibility from ground zero. Next up is foreclosure. This one hits differently because it's directly tied to homeownership. It's a devastating experience, and it leaves a deep scar on your credit report. A foreclosure signals to a new lender that you've previously failed at the exact thing you're asking them to help you do again. So the waiting periods here are even stricter. For a standard foreclosure, you are looking at a 7-year waiting period for a conventional loan. 7 years. That's a long time. For FHA loans, the waiting period is typically 3 years from the date the foreclosure was completed, which is when the property was officially sold. VA loans are a bit more lenient, usually requiring a 2-year seasoning period. Now, what about alternatives to foreclosure, like a deed in lieu or a short sale? A deed in lieu is where you voluntarily hand the keys back to the bank. A short sale is where the bank allows you to sell the home for less than you owe. For a long time, these were treated almost as harshly as a full foreclosure. But the rules have evolved. For conventional loans, the waiting period for a deed in lieu or a short sale is typically 4 years, a significant improvement over the 7 years for a foreclosure. FHA and VA loans often treat them similarly to a foreclosure, with a 3-year and 2-year wait, respectively. Again, just like with bankruptcy, if you can prove documented extenuating circumstances, these timelines can sometimes be shortened. But the core message is the same. Time and a rebuilt credit history are your only remedies. Finally, let's talk about the most common and frustrating of these landmines: collection accounts. A collection is what happens when you fail to pay a bill, and the original creditor gives up and sells your debt to a third-party collection agency for pennies on the dollar. These agencies are relentless, and that little CA on your credit report can be a mortgage deal killer. The first thing to understand is that not all collections are created equal. The FICO models used for mortgages are becoming more sophisticated. For example, medical collections are now viewed less negatively than other types of collections. Why? Because a $5,000 bill for a broken arm is very different from a $5,000 bill for a luxury vacation you couldn't afford. New scoring models can even ignore medical collections altogether, and many lenders have policies to disregard them if they're below a certain dollar amount. For non-medical collections, however, the rules are tough. Lenders will look at two things: the amount and the status. An unpaid collection account is a flashing red light. A paid collection is better, but it doesn't magically disappear. It still shows up on your report for 7 years from the original date of delinquency, and the damage to your score has already been done. Paying it off simply changes the status from unpaid to paid, which looks better to an underwriter, but doesn't necessarily boost your score overnight. So what's the strategy? First, never ever ignore a collection. Address it head-on. If it's a small amount, the lender may just require you to pay it off before closing. If it's a larger amount, you have a few options. You can try to negotiate a pay for delete. This is where you offer to pay the debt in full, or a settled amount, in exchange for the collection agency completely removing the account from your credit report. This is the holy grail of dealing with collections, but it can be difficult to achieve, and you absolutely must get the agreement in writing before you send a single dollar. If they won't agree to delete it, the next best option is to pay it in full and have it marked as paid in full. Now, here's the most important part of this entire section. Whether you're dealing with a bankruptcy, a foreclosure, or a stubborn collection, the waiting period is not a passive activity. It is not the time to sit on your hands and hope for the best. This is your rebuilding phase. This is your comeback story. The underwriter isn't just looking to see if the required time has passed. They are meticulously examining what you did with that time. They want to see that you have reestablished credit and managed it perfectly. This means getting 1 or 2 secured credit cards immediately. Use them for small recurring purchases like a Netflix subscription or a tank of gas, and pay the balance in full on time every single month without fail. This creates a new positive payment history that begins to overwrite the old negative one. You might consider a credit builder loan from a local credit union. Every on-time payment is a point in your favor. They want to see that you have 0 late payments on any account since the major derogatory event. A single 30-day late payment during your seasoning period can reset the clock or get you an instant denial. You must be flawless. They want to see that you've been responsible with your finances, that you're saving money, and that you're living within your means. And when you finally do apply for that mortgage, you will be asked to write a letter of explanation, or LOX. This is your chance to tell your story. This is not a place for excuses. It's a place for accountability. You don't say, "I had some bad luck." You say, "In 2019, I underwent a significant medical procedure that resulted in unexpected bills totaling over $50,000. Despite my best efforts, I was unable to manage this debt and was forced to file for Chapter 7 bankruptcy. Since my discharge in 2020, I have maintained perfect payment history on all my accounts, established a 6-month emergency fund, and have had no new delinquent debt." One is a story of a victim. The other is the story of a survivor who took control. Recovering from these major credit events is a marathon, not a sprint. It requires patience, discipline, and a forward-looking strategy. You've served the time, you've done the work, and you've rebuilt your financial foundation brick by brick. You've proven you are more than your past mistakes. But now that the foundation is stable, how do we build the skyscraper? How do we move from simply qualifying for a loan to qualifying for the best loan with the lowest possible interest rate? It's time to stop playing defense and start playing offense. We're about to shift from credit repair to credit optimization, and that's where the real money is saved. So let's talk about offense. Imagine 2 potential homebuyers, we'll call them Alex and Ben. They both have a good income, a solid down payment saved up, and they've both been paying their bills on time for years. On the surface, they look identical. Alex has a credit score of 690. Ben has a score of 765. Alex gets approved for a mortgage, but his interest rate is 7.25%. Ben gets approved for the same loan amount, but his rate is 6.5%. That difference, less than a single percentage point, doesn't sound like much. But on a $400,000 mortgage, Ben will pay over $66,000 less in interest over the life of the loan. $66,000. That's a luxury car. That's a full college fund for a child. That's a life-changing amount of money. What did Ben do that Alex didn't? Ben played offense. He didn't just avoid mistakes. He actively manipulated the credit scoring system, legally and ethically, to present the absolute best version of himself to the lender. This is the game within the game, and you're about to learn the rules. The single most powerful weapon in your credit optimization arsenal is your credit utilization ratio. This is the one factor you can change the fastest and that has the most dramatic impact on your score, especially in the 30 to 60 days before you apply for a mortgage. We've touched on it before, but now we're going deep. Remember, this ratio isn't about how much debt you have in total. It's about how much of your revolving credit, your credit card limits, you are using at any given moment. The standard advice is to keep your utilization below 30%. That's credit repair. That's defense. For credit optimization, we're aiming for under 10%. And for the truly elite, we're aiming for under 6%. The FICO algorithms see low utilization as a sign of incredible financial responsibility. It says, this person has access to a lot of credit, but they don't need to use it. They are in control. Let's go back to Alex and Ben. Alex has one credit card with a $10,000 limit. He carries a balance of $2,900, which he pays down responsibly every month. His utilization is 29%. He's following the standard advice. Ben also has a $2,900 balance, but he has 3 credit cards with a combined limit of $40,000. His utilization is just over 7%. Same amount of debt, but the algorithm sees Ben as a much safer bet. So, how do we get you from Alex to Ben? There are 3 primary ways to crush your credit utilization ratio. First, the obvious one, pay down your balances. If you're planning to buy a home in the next 6 months, it's time for a focused, aggressive debt pay-down strategy on your credit cards. Every extra $100 you can throw at those balances isn't just paying down debt. It's buying you a lower interest rate on a loan worth hundreds of thousands of dollars. The return on investment is astronomical. Second, and this is a bit counterintuitive, increase your available credit. You can call your existing credit card companies and ask for a credit limit increase. If they grant it, your credit limit, the denominator in the utilization equation, gets bigger. So, if Alex called his bank and they doubled his limit to $20,000, his $2,900 balance would instantly drop his utilization from 29% down to 14.5%, boosting his score significantly without him paying off a single dollar. A word of caution, before you ask, always inquire if the request will result in a soft or hard pull on your credit. A soft pull has no effect. A hard pull is a minor, temporary ding, but if you're doing it a few months before your mortgage application, the benefit of a lower utilization ratio will far outweigh the small impact of the inquiry. Third, and this is the master level technique, it's called the all zero except one method, or AZEO. Mortgage FICO models want to see that you are actively using credit, not just that you have it. If all of your credit cards report a zero balance, your score can actually dip slightly. The AZEO method is the perfect solution. A month or 2 before you apply for your mortgage, you pay off the entire balance on all of your credit cards, except for one. On that one card, you leave a tiny balance to report, something like $10 or $20. This is the sweet spot. The algorithm sees almost zero utilization, which is fantastic, but it also sees one active account, confirming you're a responsible, active credit user. This single technique can add 20, 30, even 40 points to your score in a single month. It is the definition of playing offense. Now, just as important as what you do is when you do it. Your credit score is not a constant. It's a snapshot in time, calculated on the day your report is pulled. This brings us to the second pillar of optimization, timing. And the most important piece of timing is understanding your credit card statement closing date. Most people think that as long as they pay their bill by the due date, they're fine. And for avoiding late fees and interest, they are. But for your credit score, the due date is almost irrelevant. The date that matters is the statement closing date. This is the day your credit card company takes a snapshot of your account, your balance, your limit, and reports that information to the credit bureaus. You could use your card all month, rack up a $3,000 balance, and then pay it in full a day before the due date. But if your statement closing date was a week before your payment, your credit card company has already reported that $3,000 balance to the bureaus. To the FICO algorithm, it looks like you're carrying a $3,000 debt, crushing your utilization ratio for the entire month, even though you paid it off. The optimization strategy is to find your statement closing date for each card. It's printed right on your monthly statement, and pay your balance down to that tiny ASIO amount a few days before that date. By doing this, you control the exact data that gets sent to the credit bureaus. You are literally curating the snapshot of your financial health that the lender will eventually see. This is how you can engineer a massive score increase in just 30 days. This leads to the concept of a pre-application credit lockdown. For the 90 days leading up to your mortgage application, your financial life needs to become as boring as possible. This is not the time to finance a new car. It's not the time to open a new credit card to get 10% off at a department store. It's not the time to buy a house full of new furniture on a store credit plan. Every one of those actions creates a hard inquiry and a new account on your credit report, both of which can cause a temporary dip in your score right when you need it to be at its absolute peak. During the lockdown, your only mission is to manage your existing accounts to perfection, driving that utilization down and letting your credit age mature. No new moves. No surprises. Finally, let's talk about the thing people fear the most: hard inquiries. A hard inquiry happens when a lender pulls your credit report because you've applied for new credit. And yes, each one can knock a few points off your score, but the system is smarter than you think. The FICO scoring models include a feature specifically designed to let you shop for the best rate on a major purchase, like a mortgage or a car loan. Any similar inquiries that occur within a specific time frame, typically 30 to 45 days for mortgage lenders, are bundled together and treated as a single inquiry. This is called deduplication. The algorithm understands you're not trying to get 10 different mortgages, but that you're shopping for the single best one. So do not be afraid to talk to multiple lenders. Go to your local bank, a credit union, and a mortgage broker. Let them all pull your credit within a few weeks of each other. It will have the same impact as just one inquiry, but it could save you tens of thousands of dollars by finding you a better rate. By mastering these three areas, utilization, timing, and inquiries, you are no longer a passive participant in the credit scoring process. You are the architect. You're moving beyond the simple don'ts of credit repair and embracing the powerful do's of credit optimization. You're not just hoping for a good score. You're building it piece by piece with precision and purpose. We've now put a high-gloss polish on all the positive parts of your credit report. We've optimized your balances and perfected your timing. But what if there are still a few blemishes lurking beneath the surface? What about that old medical bill that went to collections, or that charge-off from a credit card you forgot about years ago? These are the ghosts in the machine, the negative items that can anchor your score down no matter how well you manage the rest of your file. So how do you fight these ghosts? How do you exorcise the financial demons that are haunting your credit report and threatening your chances of getting a mortgage? It's not about magic. It's about a methodical, deliberate process. This is where you go from being a passenger in your financial life to being the pilot. This is where you take control. The first step is to stop guessing. Stop relying on the free score you get from your banking app or a third-party website. Those are valuable tools, but for this level of deep cleaning, they are the equivalent of looking at the cover of a book and thinking you know the whole story. You need the full, unedited manuscript. You need to pull your actual, full credit reports from all three major bureaus: Experian, Equifax, and TransUnion. The only place you should do this is annualcreditreport.com. That is the official federally mandated source where you can get your reports for free once a year. I want to be crystal clear, we are not just looking for a score. The score is a symptom. We are looking for the disease. You need the raw data, the line-by-line history of your financial life as recorded by these gatekeepers. Once you have all three reports in front of you, and yes, you need all three because they often contain different information, you become a forensic investigator. You're looking for the killers, the items that are actively suppressing your score. Print them out, get a red pen, and go through them with a fine-tooth comb. What are you searching for? First, look for collections. This is when an original creditor, like a hospital or a credit card company, gives up on trying to get money from you and sells your debt to a third-party collection agency for pennies on the dollar. A collection account is a massive red flag to a mortgage lender. It signals a history of not paying your bills as agreed, and it can absolutely derail an approval. Second, look for charge-offs. This is slightly different. A charge-off is an accounting term. It means the original creditor has written your debt off as a loss on their books. But don't be fooled, you still legally owe the money, and that charge-off sits on your credit report like a lead weight for 7 years. Third, scan for late payments. Specifically, look for payments that are 30, 60, or 90 days past due. A single 30-day late payment can drop your score by dozens of points. A 90-day late payment is treated by lenders with almost the same severity as a collection. Pay close attention to the dates. Is that late payment from your student loan servicer really accurate? Or was it during a period of administrative forbearance where you weren't even required to pay? Finally, look for the major delinquencies: judgments, tax liens, and bankruptcies. These are public records that signal severe financial distress and are the most damaging items you can have on your report. Now that you've identified the enemy, it's time to go on the offensive. This is done through the dispute process, a right granted to you by the Fair Credit Reporting Act, or FCRA. And here is one of the most important pieces of advice I can give you. Do not, under any circumstances, dispute an item online through the credit bureau's websites. It's tempting, it's fast, it's easy, and it's a trap. When you click that dispute button online, you are often agreeing to terms and conditions where you may waive your right to sue and agree to arbitration. You are also feeding your dispute into a largely automated system called eOscar, where a human being might spend less than 10 seconds reviewing your case. The correct way, the powerful way, is the old-fashioned way, with a physical letter sent via certified mail with a return receipt requested. Why? Because it creates an undeniable paper trail. The credit bureau has to sign for your letter, and that signature starts a legal 30-day clock. They are legally obligated to investigate your claim and respond within that time frame. No automated system can ignore a certified letter. Your dispute letter should be simple, clear, and professional. State who you are, provide identifying information, clearly identify the account number of the item you are disputing, and state why you are disputing it. You don't need to write a novel. This account is not mine. The date of last activity reported for this account is inaccurate. I was never late on this payment. Please see the attached proof. Stick to the facts. The burden of proof is on them, the credit bureau and the creditor, to prove the item is accurate and verifiable. If they cannot prove it within the 30-day window, they are legally required to delete it. It's that simple. Many times, especially with older debts sold between collection agencies, the paper trail is messy or non-existent. They can't find the proof, and the negative item vanishes from your report. But what if the debt is legitimate? What if you know you owe that money to that collection agency? Disputing it as not mine would be fraudulent, and it probably wouldn't work anyway. This is where negotiation comes into play, specifically a strategy called pay for delete. This is a powerful but delicate maneuver. You contact the collection agency, not the original creditor, and you make them an offer. You offer to pay the debt, either in full or a negotiated settlement amount, in exchange for one very specific thing: their written promise to completely delete the entire account from your credit report. This is critical. Simply paying off an old collection does not help your mortgage credit score. In fact, it can sometimes hurt it by updating the date of last activity on a negative account, making it look more recent to the scoring models. A paid collection is still a collection. It's a scar. What you want is for the scar to be surgically removed. You want the account gone as if it never existed. And here is the most important warning about this strategy. Get the agreement in writing before you pay a single cent. I'm going to say that again. Get the pay for delete agreement in writing, via email or a physical letter from the collection agency, before you pay them anything. Unscrupulous collectors will promise you anything over the phone to get your money. Oh yeah, sure, we'll delete it. Just give me your debit card number. Don't fall for it. Without a written agreement, you have zero leverage. Once they have your money, they have no incentive to follow through, and you'll be left with a paid collection on your report and a lighter wallet. With a written agreement, you have a contract. If they don't hold up their end of the bargain, you have the proof you need to force the credit bureaus to remove it. Cleaning up your credit report is not a quick fix. It's work. It takes patience, postage, and persistence. But every negative item you successfully get removed is like taking a sandbag off a hot air balloon. Your score doesn't just creep up, it can soar. Removing a few collections or erroneous late payments can be the difference between a denial and an approval. The difference between a high interest rate and a great one that saves you tens of thousands of dollars over the life of your loan. This is the deep cleaning that prepares the foundation of your mortgage application. You've audited the past. You've corrected the errors and neutralized the threats. Your credit report is now as clean and powerful as you can make it. You've done the hard work that most people never do. You are ready. But even with a perfect report and a stellar score, you can still sabotage your entire mortgage application with a few simple, innocent-looking mistakes in the final months leading up to your closing. You've built the perfect race car, but now you have to navigate the most treacherous part of the track. And the mistakes you make when the finish line is in sight are the ones that hurt the most. So what are these hairpin turns and oil slicks on the final lap? The number one mistake, the one that causes more deals to fall apart at the last second than any other, is opening new lines of credit. Think about it. You're pre-approved, you've found the perfect house, you're picturing where the sofa will go. And then you see it. A flyer for a big box store offering 25% off your entire purchase if you open a new store credit card. We need a new washer and dryer anyway, you think. And a refrigerator. And a lawnmower. This deal is too good to pass up. This is a trap. A catastrophic, deal-destroying trap. When you apply for that card, 3 things happen almost instantly, all of them bad for your mortgage application. First, you get a hard inquiry on your credit report which can ding your score by a few points. Second, if you're approved, a brand new account appears on your file, which lowers the average age of your credit history, a key scoring factor. And third, and this is the real killer, you now have a new monthly payment and a new debt balance. Your lender approved you based on a very specific snapshot of your finances, particularly your debt-to-income ratio, or DTI. They calculated that with your existing debts, your car payment, your student loans, your credit cards, plus your new estimated mortgage payment, you would be at, say, a 41% DTI. The maximum they allow might be 43%. By adding a $5,000 furniture purchase on a new store card, you've just added another $100 a month payment. That might not seem like much, but it could be enough to push your DTI from 41% to 44%. And just like that, you no longer qualify for the loan. The most brutal part? Lenders do a final credit pull and a final verification of your finances just days, sometimes even hours, before you're scheduled to sign the closing documents. They will see that new account. They will see that new debt. And they will not hesitate to pull the plug on your loan, even if you've already packed your moving truck. All that work, all that stress, all that emotional investment gone, because you wanted to save a few $100s on a refrigerator. Okay, so no new credit. That's simple enough. But what if I just pay cash for the big-ticket items? You ask. I've got the money saved up. This is another, more subtle pitfall. Lenders are obsessed with stability. They verified your bank accounts and they want to see that the money you have for your down payment and closing costs is sitting there, untouched. They also want to see that you have cash reserves left over after you close, typically a few months' worth of mortgage payments. If your loan officer looks at your bank statement a week before closing and sees that $10,000 has suddenly vanished, it raises a massive red flag. Where did that money go? Did you buy a car? Did you take a lavish vacation? Did you give it to a relative? To the lender, a large, unexplained withdrawal looks like financial recklessness. It suggests you might not have the cash reserves you claimed, or that you've taken on a new, undocumented debt. They need to source every dollar. That $10,000 withdrawal just created a mountain of new paperwork and questions you have to answer, potentially delaying your closing or even putting your loan in jeopardy. The golden rule between pre-approval and closing is this: become the most financially boring person on the planet. Your goal is to keep your financial picture identical to the one the underwriter already approved. This brings us to the next deal breaker: changing jobs. In the normal world, getting a new job with a 20% raise is a reason to celebrate. In the mortgage world, it's a 5-alarm fire. Remember, lenders value stability and predictability above all else. They approved you based on your current employer, your current salary, and your history in that job. When you switch jobs, you reset the clock. The underwriter has to stop everything and re-verify your employment and income from scratch. If your new job has a probationary period, the lender might not count that income at all until it's over. If you're moving from a salaried W-2 position to a commission-based or contract role, your entire income calculation changes, and you might no longer qualify. Even if it's a better job for more money in the same industry, the change itself introduces uncertainty, and uncertainty is the enemy of underwriting. If you absolutely must change jobs during this period, you need to talk to your loan officer before you even accept the offer. The other mistakes are ones that should be obvious, but you'd be surprised how often they happen under the stress of a home purchase. Do not miss a payment on any of your existing debts. Not a credit card, not a car loan, not anything. Set everything to autopay. One single 30-day late payment reported to the credit bureaus can drop your score by 60 to 100 points overnight, which would be an absolutely fatal blow to your mortgage. And a sneaky one. Do not co-sign a loan for anyone. Not for your cousin who needs a car, not for your sibling who needs a personal loan. When you co-sign, that debt legally becomes your debt. It appears on your credit report and is factored directly into your debt-to-income ratio, even if you never make a single payment yourself. From the lender's perspective, you just took on a new car payment, and your deal is likely dead on arrival. So, what should you be doing during these crucial final weeks? It's simple. You continue to live your life exactly as you were when you were first approved. Pay every single bill on time, preferably early. Keep your credit card balances as low as possible, or ideally, pay them off completely. Do not move large sums of money around between accounts without talking to your loan officer first. Don't deposit random sums of cash. Every dollar needs a paper trail. And most importantly, keep your loan officer in the loop about absolutely everything. Over-communication is your best friend. Think of it this way: you have passed the final exam. The grade is in the book. All you have to do now is walk across the stage and collect your diploma. Don't do anything that would make the principal call you back and fail you at the last second. And that brings us to the end of our journey together. Think about where we started. We took this intimidating 3-digit number that governs so much of our financial lives and we broke it down. We demystified the 5 core components: payment history, amounts owed, length of credit history, credit mix, and new credit. We peeled back the layers on the specific older FICO models versions 2, 4, and 5 that the mortgage industry still uses, so you'd understand why the score your bank shows you is different from the one your lender sees. We built a strategy, a step-by-step game plan for cleaning up your credit, optimizing your utilization, and building a robust history that lenders want to see. We talked about rapid rescoring, authorized users, and the small hinges that swing big doors in the world of credit. We navigated the pre-approval process, and now we've crossed the finish line, avoiding the last-minute pitfalls that trip up so many hopeful buyers. This series was never just about a number. It was about what that number represents. It's the key that unlocks a front door. It's the financial leverage that turns decades of paying rent into decades of building equity. It's the tool that allows you to plant roots, to build a life, to turn a transient address into a permanent home. The credit system is complex, it's frustrating, and at times it can feel profoundly unfair. But it is no longer a mystery to you. You now have the map. You have the knowledge. You understand the rules of this specific game better than 99% of the people who play it. You are no longer just a passenger, hoping the driver gets you to your destination. You are the pilot, in control of the instruments with a clear view of the path ahead. Knowledge is power, but applied knowledge is freedom. The freedom to choose your home, to secure your family's future, and to turn a dream into an address on a mailbox. Go build that future. You've earned it.